Let's talk about what happened with dollar, rather what didn't happen with dollar. Posted 215 print on non-farm payrolls. I mean, it's as if, you know, everybody collectively in the market kind of went like, okay, I believe Yellen. Yep, there's, you know, this whole dovish thing.
Yeah, well, I think it was kind of very much a continuation of what you might describe as a bit of a Goldilocks number. So payroll's quite strong, wages ticking up, but not too aggressively. So it's kind of like the US economy is doing okay, but it's not doing strong enough to kind of see the market significantly reprice the Fed outlook.
To offset the dovish case that Yellen is laying out.
Well, that's exactly right. So I think for now the Fed is still probably off the table at least for the next kind of 2 to 3 months. So from that perspective, then the pain trade for the market, or probably for longer term investors, is the dollar probably continues to weaken from here.
More clues, of course. We got Fed minutes coming out this week to see whether or not she's sort of all alone out there at the end of the plank or not in terms of dovishness.
Well, that's exactly right. I mean, we did see after her speech from a few weeks ago, a few FOMC members came out and sounded a little bit more hawkish than what she did.
So she beat those guys back, right?
Yeah. So I mean, it could be the case that we see the Fed minutes probably sound a little bit more hawkish. But if that is the case and we do see the dollar bounce, I think the market's going to sell into that rally because Yellen is clearly the most important voice from the Fed at the moment.
Okay, as the chair and RBA coming up tomorrow.
Yeah, absolutely. I think if you look at all the Asian currencies moving at this point in time, which is your favourite currency to short right now, if you want to short one?
In terms of being short Asian currencies,
absolutely.
Probably on a cross basis, it'd be something like the Singapore dollar or the Taiwan dollar. The Singapore dollar, we're well above the midpoint of the band. We don't think the MAS is going to ease at this stage, so that's probably justified to some extent, but we think that Sing and Taiwan are probably going to lag what we think is a risk-on rally. So both low yielding, we think are going to underperform some of the higher beta currencies in the region. So we like being short Taiwan against the Korean currency, for instance, and we like being short Sing against the Malaysian ringgit and the Indian rupiah, where we think there's more value.
And tactically long AUD, at least in the short term, assuming even if the RBA does not move to cut rates tomorrow.
Yeah, I mean, I think again, the pain trade for the market is the Aussie dollar probably higher from here. This morning's data wasn't great, but I don't think it's going to turn around the Aussie dollar in a significant fashion, at least in the short term. With China's data from last week, we actually upgraded our Q2 forecast for GDP in China for the second quarter. So I think that's quite an important development in terms of China stabilising. The Aussie dollar is the best proxy for the market in that at the moment. So I think the risks are that we continue to grind higher and the Aussie dollar can still outperform things like sterling, at least for the next 1 or 2 months.
How much higher?
Oh, I think 78 cents, something around that type of region is probably...
80's a stretch?
Well, I think 80's probably a stretch where that RBA rhetoric probably really comes back to kind of create some
What currency will you fund this move with, actually? In
terms of being long the Aussie dollar?
Yeah.
Short sterling at this stage is probably our preferred trade because of those. Well, I think the Brexit fears, given the developments in Europe, etc., only probably going to be a bit more accentuated. So short sterling is still probably our preferred trade, at least for the next 1 to 2 months.
Are you calling for a Brexit or?
Yeah, seriously, what odds do you put on a Brexit?
We still put them at reasonably low levels at this stage, but that doesn't mean the market can't hedge more risk in terms of being more short sterling than what they are from current levels.
So at what level would you go long sterling then, if you think that they're not going to hit for Brexit?
In terms of being long sterling, somewhere definitely below the 140 level. If you see that kind of realised at some stage over the next, you know, somewhere between 136, 138, I think is probably going to be where investors are going to start to probably trim some of those hedges back.